This is Scott Wentsel from Wentsel Wealth Management, and welcome to our market review for the first quarter of 2018. The markets generally were down for the first quarter of the year. The U.S. market was down 0.64% and broke a string of 9 consecutive quarters with positive returns. So we had a bit of a correction this quarter. You can also see international developed markets were down over 2%. Emerging market stocks were actually a bright spot. We're up slightly, up 1.42% for the quarter. You can see REITs, or global real estate, was down 5.79%. And on the bond side, we also had a decline in U.S. bonds as interest rates rose. So a broad measure of the U.S. bond market was down 1.46%. And then conversely, global bonds were positive, so we had a 0.94% rise in non-U.S. bonds, primarily due to weakness in the U.S. dollar. And here's a chart looking at sort of the 3 months for the quarter and tracing the performance of the world stock market. And there was kind of a lot of things going on for the quarter. So we had a tremendous market rally in the month of January, and the U.S. market was up about 7% for the month, and really led by what was going on in technology stocks primarily. So the market in a lot of ways got ahead of itself for the month, rising quite a bit for the month of January, and then we kind of started hitting a correction time. So we had sort of concerns about inflation, so you can see that happening right here, concerns about inflation, and then starting sort of leading to a rise in interest rates, and then really leading to a pretty rapid correction in stocks. So the market plunged pretty dramatically and volatility went up quite a bit. So we had corrections defined as a decline of 10% or more from the highs. So we reached a correction in February pretty rapidly, and then had a number of really just a lot of increased volatility and market going up and down and reacting to a lot of different news items throughout the rest of the quarter. So I think as I mentioned earlier, the dollar was weak for the quarter, so dropping to its lowest levels since 2014. We started having talk about tariffs and the trade war, so that news kind of made people on edge, and things got worse as that went along. We had the Fed raise interest rates one time in the quarter, so a lot of concerns about rising interest rates and people perhaps expecting the Fed to raise rates 2 or 3 more times this year. So a lot of news items, and really kind of a tale of 2 different regimes for the quarter. So the very dramatic rise in January, and then the decline and increased volatility in February and March. And I thought one of the more interesting things was, in a way, a change in the way bonds react when stocks decline. So over the past several years now, when the markets declined, Treasury bonds, there's been a flight to safety, and Treasury bonds have rallied and rates declined, and really been a good diversifier and really helping lowering rates and helping the stock market regain its footing. And so that didn't happen this time when the market went down. So rates stayed fairly elevated, and just again leading to more concerns of higher rates. So again, a lot of things happened in the quarter, but it's always important to keep a long-term perspective. Our goal as long-term investors is really just to benefit from growth in the global economy and ride it out for the long term and benefit from the higher returns of investing in the capital markets. So while it's interesting to track the news of the markets, it's important to maintain a long-term perspective. So here's just looking at the U.S. market and looking at the graph in the upper right-hand quarter. You can see growth style stocks did better than value style. So if you think about growth style, that would be technology and healthcare type companies. Here's the value style stocks, so underperforming growth by quite a bit, and value would be things like energy and financials and basic materials. So you can see pretty good divergence there between the 2 styles. Also for the quarter, we had smaller companies slightly outperform larger companies. So small cap growth was the best performing style for the quarter. And looking again at international developed stocks, we see the kind of declines across the board. And similar story, you had smaller companies and growth style companies doing better than large and value style stocks. And then I always think it's interesting to look at the differences in performance between local currency and U.S. currency. And so you can see, kind of the differences here. And roughly, the currency impact added about between 2 and 2.5% returns for non-U.S. stocks for the quarter. So that's the effect of the declining dollar and boosting returns on non-U.S. stocks. So even with that currency help, though, developed stocks, non-U.S. stocks declined for the quarter. Emerging market stocks were a slightly different story, positive returns. Value and large cap emerging market stocks did a little bit better, and you can again see that currency gap in performance. Looking at the returns in the chart in the upper right corner. So again, emerging markets were a bit of a bright spot for the quarter. And here's performance of all the different countries out there. So you can see in the developed market side, in terms of major markets, you can see Japan actually did quite well, or did better than average, I guess. It would be up 1.06%, and a lot of that was based on strong currency performance. Other major economies, you can see, Hong Kong here, Germany and the UK, both were pretty weak, and then, kind of down at the bottom, Canada and Australia. So you can see a lot of developed markets had a bit of a tougher go for the quarter than the U.S. market. Over on the emerging market side, Brazil was a standout. Russia did quite well, so that's interesting. And then, China and Mexico both were positive, so both important emerging market economies. Then on decliners, India is sort of a one that's pretty important and had a pretty big decline for the quarter. So again, you see a lot of mixed performance among the countries, and so always good to be diversified there. And again, I mentioned the currency performance versus the U.S. dollar and how important that impact was for the performance of non-U.S. markets. So you can see, again, Japan and the yen, doing quite well for the quarter. Here's the euro. Advancing for the quarter as well. So all of those giving a tailwind to the performance of non-U.S. stocks for the quarter. And then over on the emerging market side, you again can see Mexico, the peso doing well, and again the yuan doing well. So a lot of again really has a big impact on how the markets do overall. Commodities were down slightly for the quarter. Corn and soybeans were up quite a bit. Oil was up modestly as well for the quarter. In terms of decliners, natural gas continues to weaken. And then other things like coffee and sugar and live cattle and live hogs all had pretty big declines. So kind of mixed results for the commodity complex. And then last, looking at the fixed income sector, an important thing that happened in the quarter was that rates went up kind of across the board. You can see the yield curve advancing versus year end, really again across the board from the 1-month maturity to the 10-year maturity. All the yields rose by about 35 basis points. And then on the 30-year Treasury bond, yields rose about 23 basis points. So an advancing rising yield curve led to declines in bond prices for the quarter, and that would lead to the negative returns that we saw on broad bond indices. So rising interest rates were a pretty big story for the quarter, and then again caused people to worry about inflation and further increases in interest rates, and helped lead to some of the concern over the strength of the market. And that wraps up our market review for the first quarter of 2018. If you have any questions about any of this material, I encourage you to reach out and contact me, and I'd be happy to get back to you. And I want to thank you for taking the time to listen to this update, and I hope to speak with you again next quarter.